What's going on, everybody? Thank you for joining us. It is Thursday afternoon. I have a guest and friend, Jennings Smith, on today. We're going to talk about the hot topic of the past couple of years, and that's multifamily or apartment investing. Jennings, thanks, man. I appreciate you being on, taking some time out of your busy schedule to just kind of take a dive in here and talk about what you've really excelled at in the past few years, and that's apartment buildings and whatnot. So, Jennings, with that said, man, why don't you just kind of really quick, just give a little bit of background and about yourself and how you got involved into multifamilies.
Yeah, absolutely. Thanks, Ryan, and I appreciate you having me on your show. I'm excited to be here and talk to you and your audience. But yeah, I about 7 or 8 years ago, I started to buy a few mobile homes, and then I moved into the single family arena. Bought two single family homes, and then was going to just sort of trade my way up that way. And I wasn't a wholesaler. I really didn't even know that existed, to be honest. And I talked to some bankers, and they said, Jennings, if you want to build a large portfolio, it's going to be really hard to get to like 1,000 units with trailers and single family homes. And when I did the math on how many homes I'd have to buy per month and trailers I'd have to flip, it was just kind of daunting. So I thought, well, maybe I need to shift gears. And I saw a course online and bought that. It was about on how to close your first apartment deal, and went through that, pretty overwhelmed and had very little experience. So, but I started looking and I started studying it, and I kind of studied and halfway looked at it for about 2 years before I closed my first 12 unit apartment. And it was a small deal, owner finance deal. I raised the down payment from an investor, and I just did like a joint venture. He brought the money and we split it 60-40. He got 40, I got 60. So I got a good bit of equity in that deal. And then about 18 months later, we sold it and made a profit on it. And after I closed that deal, I started to see the Burr model, studied some of Tim Brotz's stuff. We're both in the DM family with him.
Sure.
And that really opened my eyes to bigger deals and how to do this. And I did that for all about 2019, closed a couple hundred units in 2019, and then moved into it full time. And so now we've got, between the self-storage, the multifamily, and the mobile home parks, we got like 13 or 1400 units. So I did break my 1,000 unit goal. However, I don't own all those myself, right? I have partners in it, but it's taken off. And so I've got a multifamily Facebook group, my first million in multifamily, and that's grown. There's, I think, 20 something thousand people in there. And we have a mentoring program, the Deal Room, which is like a paid private group. And there's a two or 300 people in there. And so it's really grown, and I've really enjoyed it, and I've gotten quite good at it, and it happened fast. In the last 3 years, we went from owning a couple trailers and two single family homes to 1,400 units.
Wow, and honestly, that's impressive. And I've seen, you grow over the past year or two, and you just got exponential growth, and it's pretty impressive. So let me ask you this: for some of our listeners that maybe don't have, that many units, maybe they're just starting off. If they might say, oh, there's a lot of the gurus that that tell us how easy it is, and they got thousands of units. Well, let's kind of just backtrack a little bit, right? Let's just say, you're starting over, and you want to get your first apartment, whatever, however many units that may be. What are the first steps that you would take, right? I mean, probably identifying your market would probably be step one, I'm assuming.
Well, I think a lot of people think that, and it really is not as critical as you might think. Because I focused mostly on my market in the beginning, and I couldn't find anything that made sense. I live in Charleston, South Carolina, and it was fairly expensive market. And I know a lot of your listeners probably live in expensive towns. And so when I started to look outside of my market, like the first deal that I closed, it was a 5-hour drive, right? So I couldn't manage it. I had to find a management company. I could still go up there every couple of, 1 to 2 months, but I wasn't going to be swinging by there after work, every day.
Sure.
And so that was a limiting belief that I had to buy in my own market and area. And while it does make it easier, I'm not going to lie, it definitely makes it easier if you can find something. And if you live in a market that has good deals, then by all means buy in your market. But I don't really look necessarily at, I look at markets I don't want to be in, right? There's definitely markets I don't want to be in. We all know that, as far as high crime, rent controls, high taxes, don't really want to mess with that. But other than that, I'm fairly open to opportunities. I don't just limit myself. Like, I only buy in South Carolina or North Carolina. So if I was starting out again, I think that the first step is to get the basics down, right? Understand by, I mean, how I started was I took a little course. It was a small investment. It was like $1,000. I think the course is $2,000 now, but learn the basics and really make an educated decision as to, is this something that I want to dedicate a lot of time and resources and passion to? Is it worth it? Right? Looking into, well, what does the math say? Right? That's what shifted my course, was I did the math, right? If you do the math on the cash flow and how many units it's going to take and how much equity you're going to get and what it's going to look like 20 years down the road, it sort of gives you the ability to know how much effort you should dedicate to it and if it's worth it. So that's what I would do first, is this worth it to me? Is this the highest and best use of my opportunity and time? And for me, it was. And I was already in real estate. I liked it. I saw the scale of multifamily and I thought, this is for me. But once you've decided for sure that this is what you want to do, I think that, that you got to get those basic building blocks of education, like how to underwrite, how to see what's a good deal. And you can learn this stuff for free on YouTube. Like, you don't have to buy a course like I did, but you got to learn that stuff. You have to. And if you want to it takes longer to learn it for free because it's scattered all over the internet. You can spend a little bit of money and do it. But if you're strapped for money and you have plenty of time, then just find this stuff online. You can find it mostly for free. But if you can't, then just get a course. But that is not enough, right? Because everybody, the information in and of itself is not the rocket science. Multifamily is a team sport. You need a loan sponsor. You need a lot of money for down payments. You need to have an operational team, property management, boots on the ground, asset management, all this stuff. And so the biggest thing is a network, plugging into my network and building my network of investors and building my network of partners, because there are not many people that are taking down multifamily deals by themselves. So that's what I would focus on. I mean, building blocks of basic education, absolutely. But a course is not going to get you a $60 million portfolio in 3 or 4 years. You have to connect to the correct network.
Right. So, I mean, was it safe to say, like, so for example, there's obviously different deals are going to produce different outcome, right? Like, so for example, if you're going maybe out west or Midwest or something, you may have better cash flowing properties. Whereas here in New Jersey, you're looking at very, very low cap rates. The purpose that I would take is that, hey, especially now people are uncertain where to put their money or preserve their wealth. Maybe they're more inclined to park it in real estate or multifamily buildings just to preserve, not necessarily get that appreciation or cash flow per se, but again, more of just like a preservation versus, so if somebody says, look, I'm not in this just to preserve, I want to make some serious gains, that's obviously going to dictate, where they're maybe looking and stuff. So is it safe to say maybe to identify the type of, or, the expectation that they have that the multifamily is going to provide for them?
Yeah, I think that you need to, what constrains multifamily, like what kind of deals you buy, what areas you buy, the asset class you buy, like, are you buying A, B, C, D? Are you doing value add? Are you doing stabilized? All that is constrained by your investor base, right? Your investor base to mostly, and then your debt to some degree, the rates you can get on the debt, the term you can get on the debt. But so you want to back into that equation where if you've got your investor base and you want to pitch, like, if you want to make serious money in multifamily fast, you got to solve problems, right? Just like you guys do as wholesalers, you got to go find the messed up property that people don't want, or the owner's in a jam and he needs to close fast. and the bank's breathing down his neck, or he's owned it for 30 years and the sun's running it into the ground or whatever. You find those sort of off market apartment deals that need $1 million of renovation, but the rents are a couple $100 under market rent. And you push the rents up 40% on a $5 million building, you just made $2 million. You just increased the value of that property by 40% if you push the rents 40% in a general sense, I mean. But so if you want to do that, then you can pitch more aggressive returns to your investors. However, there's more risk, right? You have construction risk. You're buying stuff with very weak cash flow. You're buying stuff with rough tenant bases, higher delinquency. Maybe they're not paying. Maybe you got squatters there. You've got the reputation to overcome with trying to turn the property over. You've renovated units and they're nice, but the other half of the tenant base is not nice. And then there's a shooting in your complex, and who wants to live there? Like, those are the kind of problems you got to overcome if you're going to make a whack of money quickly. So if you want to attract that kind of investor base, and that's the kind of work you do, then you structure your capital raising around that. If you want to do, A class, where you're selling the people on, hey, I'm buying in Austin. I'm buying in Florida. I'm buying in the Carolinas. I'm buying in Nashville, Tennessee. Like, I'm buying in the best markets, the hottest markets. We're paying top dollar. However, these properties are always going to be full. Rents are always going to be going up. They're always going to be in demand, and they're in great shape. They're built from the ground up. They're only a couple of years old. Like, yeah, the cash on cash return is not great, but this is safe. We're only putting, 60, 70% debt on it. Or in Grant Cardone's model, he does a much higher leverage, but sometimes it depends on his deals, but he's selling them on the appreciation. And although Grant Cardone's preferred returns are very low, or in some cases none, he has returned decent returns on a lot of his deals because, stuff he bought 2 or 3 years ago, he's looking pretty smart right now. The valuations and the sales on stuff, and he's buying them. They're really not generating cash. And then 2 or 3 years later, he's selling them for 20, 30% more than he paid, or more than that. And that's the appreciation game. And that is awesome, right? When it works for you. When it doesn't work for you, you're still okay, right? You're kind of treading water. You're not, as long as you bought it well enough to afford your bills, you're sort of just treading water. You're waiting for the market to turn in your favor. And for the most part, multifamily is pretty steadily trended up along with rents over the last 70 years. I mean, if you look at the rent chart on multifamily rents, it's like a straight line up, except for like 2008 to 2010, where it's flat, then it keeps going back up. So it's a very stable metric. But I like to play the value add game where I know the market rents or under market rent. And if I get the appreciation piece too, awesome. If I don't, I'm still fine because I forced the appreciation through the value add. But there's a lot of risk and there's a lot of headache that comes along with doing those kind of deals.
Right. No, excellent feedback. So, just to kind of rewind a little bit, you mentioned, like, obviously this is a bit capital intensive, right? It's not like your typical, single family house and you can get in. I mean, sure, you could do no money deals, but and you could find them for almost nothing. But, for example, due diligence on some of these properties are 10, 15 grand, right off the bat, just doing some, basic due diligence, right? So, people that are expecting to get into this game with like no money and not spend any out of pocket costs is not really realistic. Also, you mentioned about, team members and stuff like that. Do you think that it's best for the person to, you talked about just doing, practicing deals just to kind of understand, the type of investment, how, maybe to underwrite a deal, stuff like that. Do you think they should go through some of that stuff first, get a foundation, and then start building their team before they hunt for deals? Or should they find the deal and then the team and the capital will flow, kind of thing? What's your thoughts on that?
Going back, I think that the more educated you are, the more valuable you are. And so when you start throwing things at experienced people, such as myself, like, right, I get random messages or emails or whatever from people that are maybe in my big Facebook group, or maybe they just know me. They're like, oh, hey, what do you think about this? And within 3 minutes of looking at it, I'm like, this is not a deal. This is a terrible deal. It's
Right.
run down. It's in a bad market, or it's way too expensive. They want $200,000 a door and they're getting $1,100 a month in rent. Like no. And then I remember, okay, that person doesn't know what they're talking about. They're not credible. Just ignore everything that they ever say from this point forward. Like,
Wow.
I hate that it's that harsh, but it's just like,
Okay.
I'm so busy.
Yeah.
And the people that can actually be a good teammate and help you get your stuff done, they're busy. Right.
Yeah.
And if you waste their time and you throw crap at them, that is just like, you obviously don't even know the ABCs of multifamily, then it's going to hurt you. Right.
Sure.
I'm definitely all about taking action, but you don't want to burn those bridges. And so I would always recommend doing some preliminary underwriting, educating yourself and knowing, hey, I think I got something here. Here's why I think I got something, and rolling it up into a little bit of a, like, here's the numbers, here's the analysis. I did a little bit of work for you. Then just throwing me like a deal you found off LoopNet. I'm like, I'm not underwriting your deals for you. I have enough on my plate. I'm not looking at that.
For
Like,
sure.
I don't care. And it's probably not a deal.
Yeah.
So I would say, don't just start throwing stuff against the wall. I would say invest in yourself, but don't get stuck there. Right. I think a lot of people, they're happy to learn and they become just lifelong learners and they never do anything. You know, they
Sure.
never get out there and get in the trenches and make stuff happen. And they just educate and they never pull the trigger.
Right. You don't have analysis paralysis. And that, that's a great point. That's part of the reason why we do these shows. It's to really not just to give back and educate people, but I'm looking for future partners and people to provide deals, right? So the better they're educated, the better they're going to be able to provide me a qualified deal, instead of just like, hey, here's a house and they're expecting you to do all the legwork. And that's, I'm with you. I mean, you don't want to discredit somebody, but you got to be providing value, right? You have to go ahead, show that you know what you're doing, so that someone will take a second look, give you the time, and take it seriously.
So case in point, my private group, the deal room, you can, we were allowing people to join the deal room without having gone through the course or the course that we have. And we would do a live underwriting call every week, and people were bringing stuff that was just not a deal at all. And it's fine. It's part of learning, but it's kind of aggravating. And so what we did is we said, hey, if you're in the deal room now, you get access to the course. Like, we want you to be educated. We're going to give you access as long as you commit to stay in the deal room for a year. We'll give you the course right now. And then the quality of the deal submittals just went through the roof. And now we're getting a couple of deals a week that are going under contract, and people are closing, and they're phenomenal because they know how to sort and filter through that stuff, because they just took, within 2 weeks, right? 2 weeks of just watching some videos, learning basic underwriting, you can get a grasp on this stuff. I'm not gonna say you're a master, but you can get a grasp. You can speak the language.
Sure.
Versus some people, they'll never sit down and go through a methodical, this is how you submit a letter of intent. This is how you make an offer. This is how you underwrite stuff. This is how you analyze stuff. It's how you structure your partnerships. And you're going to be head and shoulders above other people when you're trying to make these partnerships and teamwork. So the more valuable you are, the better people you're going to attract to your team. Absolutely.
And also, when people pay, they pay attention, right? And we see that with, high level mastermind that we're in. It's a separator, people that are expecting everything for free and to be spoon fed. Unfortunately, they're typically not the people that excel. It's the people that are willing to invest the serious money, and then they take it more serious, right? Sometimes you get something for free and you're like, okay, I'll get to that whenever. Whereas if you write a decent check for it, you're hey, that's money wasted and time wasted. And like I said, it's kind of a separator, right? To eliminate those that are just tire kickers and those that are serious.
Absolutely. I mean, I've given a couple copies of my course away to people just because I knew them or as friends, and I can see on the back end, they never open it. They never go through it. They never versus someone that paid $2,000 for the course. They watch it. You better believe they're going to watch it because they've invested in that. And so they want to make it work. And the same thing, the deal room is monthly. And when that monthly bill hits, if they haven't been that active and they haven't really been searching, and they've kind of like put their goals on hold, it hits them with a little bit of pain to say, hey, remember what you promised yourself you're going to do. Get back in there, get engaged, just keep building your network, keep hunting, keep connecting, and deals get done through that accountability.
Right, absolutely. So, I mean, full circle, it sounds like, hey, what, maybe not necessarily, build a team or whatever. It's more so, hey, maybe you're better off connecting with somebody like yourself who's done plenty of deals that, if they can bring you a qualified, a decent deal, that they're going to perhaps JV with you, they'll learn in the process, and you already have the team and the systems and all that in place that, they may feel that, it may hinder them to set all that up and maybe never get to the next step. Is that accurate?
Yeah, I think the best and easiest way to break into a deal and break into this world is one, find a good deal. If you can find a good deal, then you're going to attract people that can help you get that deal across the finish line. And the more valuable you are, like knowledgeable and know how to raise money, or maybe you have your own capital to bring to the deal, or you know how to property manage, or you can be an asset manager, whatever, the more valuable you are, the bigger piece of the pie you're going to get of that deal. So finding a deal is great, but it's also really hard when you don't have a track record to find a deal, because brokers don't super take you seriously. You don't have a track record to speak of. You don't have probably millions of dollars in the bank, and you don't have experience, and they can feel that through the phone, and they think you're wasting their time possibly.
Right.
And
For
so
sure.
it's not, and you guys maybe have seen this with wholesaling, right? You're a lot more confident on your 100th or 200th wholesaled home when you're talking to that homeowner, like, yeah, we can close this thing in 30 days, no problem. Versus your first one, you're probably a little bit more nervous, and that homeowner probably can feel it.
Yeah, absolutely.
So finding the deal is hard when you're first starting, but what is very successful too is raising capital. And I always encourage my students, my people, to do both tracks, like work on those broker relationships, but also work on your investor relationships and database, because somebody that you're connected with, a lot of times it can be a wholesaler. A wholesaler comes across some little apartment. They really don't know what to do with it. They're interested in apartments maybe, and they bring you the deal. And now you have the ability to raise 500 grand for the down payment. And you bring on one more guy to help you guys get the loan, and boom, you got a deal because you were ready. You had your well dug, you had the money pre-raised, and you were ready to go. So I always encourage people, yes, definitely start looking for deals or connecting with wholesalers and brokers and apartment owners, but also start working on building your investor base.
Right. Now, I mean, talking of deals, right? We know, residential, it's a seller's market. It's a hot market. From what I know in the multifamily space, since you've gotten into it, the past 3-4 years, it's gotten a little more challenging, right? The deals are a little less plentiful, right? Or lesser cap rates and whatnot. I mean, is that a fair statement, or are you saying that that's maybe not necessarily the case?
Um, I think it's, for the most part, it's a loser's limp. It's an excuse. It's like, I'm not going to say it's not true.
Uh-huh.
But at the same time, the market is changing, right? So we don't really know what fair market value necessarily is, right? I mean, rents, I just saw some article, like rents went up 20%, I think, in the last quarter or something. And prices are like, we're looking at buildings that we're renovating, and we're already getting valuations above our pro forma, and we're not even halfway done with our renovations. So,
Right.
the market is definitely pushing up. And so this is where you just got to be wise as to, well, is this a bubble, or is this, we're going to look back in 2 or 3 years and be like, that wasn't an expensive price. That was a cheap price. I should have bought that.
Sure.
Right. The rents that were 1,200 are now 1,500, and what was worth 3 million is now worth 4.5 million. And so I should have bought, and now it's even more expensive. So my thought is, learn the underwriting, learn your cost of capital, and always be hunting, right? Even in today's markets, you can still find wholesale deals, right? You can still find somebody that's motivated, somebody that wants to sell, somebody that'll owner finance, somebody that'll do a seller carryback. And you got to get creative on how can you pay more. You can pay more by, maybe you're raising your money in a different way. Like maybe the investors aren't getting as big of a return because the market's hot. And if we win, we can sell it for higher price in 2-3 years, then great, the investors win. Maybe you can negotiate, some owner financing, or the owner will be one of your investors and they're going to defer their payment or part of their payment for a couple of years. And that allows you to pay a little bit higher price. Maybe you do a traditional syndication where you're giving away 70% of the deal to the investors, or even 80% of the deal to the investors, and you're just making most of your money on fees to get in the deal or to tread water while this cycle is going on. But to say there's no deals and I'm going to sit here and wait. I mean, people were saying that about house values in 2017, 18. Oh, prices are too high right now, I'm not going to buy. And where are they now? Right. Everyone's got PTSD about 2008, 9, 10. And this is not 2008, 9, 10, right? This is completely different. I don't know what it's going to be, and nobody has a crystal ball, but to say this is what happened then is going to happen now, which I think is what most people are drawn in comparison to, is patently false, right? We're not getting liar loans. We're not getting artificial. We're not getting people with no down payments buying houses that aren't getting their references checked and don't even have a job like we were in 2010. People are still putting down, at least in multifamily, they're putting down 20, 25%. If you can cover that mortgage and you can amortize that debt and you can cover your expenses, you're probably going to win long-term in multifamily, even in this market. Now, if you're expecting, I'll be able to raise rents 5% this year and 10% next year and another 5% in year 3, and then we'll start breaking even. That's definitely dangerous waters to be treading in. So that's kind of my thought on how to, you got to look harder. You got to build your network deeper. You can't just go on LoopNet and find a great deal. It's just not going to happen. But it doesn't mean that they're not there. But if you believe that they're not there, you believe everything's expensive and there are no deals, then that's what your brain and that's what you're going to find is no deals.
Right. No, I appreciate the perspective. So, I mean, let me ask you this. Let's say your students starting off, right? They went through your course, they've underwritten a couple deals and whatnot. What would be like the next steps for them to find their first deal, right? Like earlier you mentioned, hey, they're going to be talking to brokers. They don't have the track record. They may not be taken seriously. So are they still going to try to attempt to go through brokers? Should they start going through direct to homeowner? If it is through the brokers, what can they do so that they are taken more serious? What's the best way to ensure, if they had to find a deal, if their life depended on the next 30 or 60 or 90 days, whatever it may be?
Yeah. So I think that as they've invested in themselves and they started to build their network and they've started to build an investor base, that's going to give them a lot more confidence, right? If you've got $500,000, $1 million in soft commitments of people that'll give you money for a down payment, then I can probably close $2 to $3 to $4 million deals. And so then when you're talking to that broker, it's like, I'm partnered with this group of investors. We're looking for the $2 to $4 million range. We've got the capital ready to deploy. We're just searching. That's a lot more strength than, hey, I'm just getting into multifamily. You got anything? What do you got on your docket? Because where you want to be is, just yesterday, I called a broker I got a property in Illinois. I called a broker in Iowa and right across the river. And I'm like, hey, I got a property in Illinois. We want to sell it. We want to sell it this summer. This is where we're at. This is the rent rolls. This is the T12s. This is the pricing I'm looking for. And he's like, okay, cool. We'll start. So he drove over there. He took some pictures. He's going to put together a big portfolio or packet and push it out. He's a national broker, CBRE. He's going to push it out nationwide.
Right.
But before he does that, right, he's going to call 10 or 15 people on his short list and say, hey, I got something coming up.
Yeah.
115 units for $65K a door. You interested? And one of those guys, may snap it up, or at least they've got first right of refusal before that thing goes out to 10,000 or 10 million people on their email list.
Yeah.
And it turns into a bidding war. He's going to get the inside track on that deal. So maybe he doesn't necessarily get a cheap deal, but he gets a good deal that would have been snapped up had he not known that broker. And that's where you want to be, is where you're getting those pocket listings, right?
For sure.
Those brokers, they're calling apartment complex owners all day long. Hey, you want to sell? Hey, you thinking about selling? Hey, I can get you offers. And then they turn around and they call their base and say, hey, I got something, you interested? And at this point now, I have 3 or 4 brokers that call me pretty much with every deal that they get before it goes to market. So I sort of know, and I can say yeah or no. And that's a good place to be, but you got to build your way up to that. So yes, I would definitely build those relationships.
Right. And actually, just to add to that, right, there's it's slightly different lingo, if you will, in the commercial versus residential, right? So it's probably smart to try to learn a little bit of that, just so when you're talking to the broker, you sound like you're a little bit more experienced versus, again, like you were saying, hey, I'm just looking to get in and flip a couple houses and whatnot.
Yes, there's a language. There's an absolute language. And when you're speaking with a homeowner, you want to speak in real clear, direct terms, and you probably don't want to use lingo too much to confuse them. But when you're speaking to a broker, he eats, sleeps, breathes commercial real estate, and he's used to talking with guys with hundreds of millions of dollars in real estate, and they speak his language, and he can tell, if you don't know what NOI is, cap rate, cash on cash return, IRR, and these just general basic terms, then you probably don't, you're a poser. And if you're a poser, then you're probably wasting my time. Right. So that goes back to my first building block is you've got to learn the fundamentals. And first thing of that is speak the language. On the flip side, if you use that language with them, then they're going to give you credibility almost instantly, where they're like, oh, wait, okay, this guy, yeah, I don't know him, I haven't heard of him, but he speaks the language. So he probably knows a little bit. Let me give him a little bit more credibility, a little bit more time, and then maybe that branches into a relationship.
Right, absolutely. So, I mean, let me ask you this: you have a decent amount of units. What does like your team look like? Size of the team, roughly? Because obviously you're not managing this all yourself, and you're not doing all the marketing, right? Like, what is like your team members and systems and all that look like?
Gotcha. Yeah. So we have when we got started, we connected in our network with a loan sponsor. So this was a person who could help us. They helped us raise a little bit of the money in the beginning, and even invested personally in the beginning. We pretty much raise all the capital now, but they're on the team and more in a passive role. But Yaden is my cousin, and we're the asset managers of everything. And we each have an executive assistant, and then we have a property management company for each property. And we have one management company that has about 70% of the properties. And then those property management companies also have construction arms. So the construction is kind of connected to the management company, which is nice because they can work together with the scheduling and the budgets and the cash flow and all that. And so it's not a huge team, right? And now I would say that if I was to grow to maybe another 1,000, if I was to take on another 1,000 units, then I would probably need to expand the team and get like a full-time asset manager. But at this point, we're going to be shedding a couple properties this summer. And so then we'll be looking to replace those. I don't see myself scaling up another couple thousand doors at this point. Just I like the size. We can kind of manage it. I've got my education stuff with the deal room and my first million in multifamily. I'm really loving that. And we're still closing deals. We closed a 280 unit self-storage last week. So when opportunities come, we do that. Sure. But I'm not one that I want 10 employees to do this,
Right. Relatively smallish team and manageable. And not to dive too much into the property management, we could do a whole show on that, I'm sure. But these are all third party, right? This is not in-house or whatnot. Okay.
Well, Yaden and I we started our own management company and had, I don't know, maybe 15 or 20 rental homes. And we grew that to about 100 units. And so when we bought our first 19 unit that we syndicated, right, we raised capital and closed it. We did the management in-house. And after a year or so of doing that, we realized, okay, the money's not in the property management and we don't want to focus on this. It's taking a lot of time. Yeah, we're making some money on it, but not if we could just close one more deal per year, that would completely replace this whole management company. So let's just focus on acquisitions and let the pros do management. And now that we're bigger, I mean, a multifamily management company is much different beast than a residential management company. And the people that are really, really good at it, they're really good at it. And it's not something that I wanted to go down the road. So I'm like, why don't I just find some of the best people and hire them to work with me?
Yeah, I mean, as long as you got the right company, right, and it still makes sense cash flowing wise, it's a no brainer. Heard some horror stories of people, having their own construction company management company, and decided this is just not a good route.
Yeah, I mean, management companies are, well, it's just not a business that I wanted to. I like it in that it's repeatable income, right? But and subscription based income, but it's not. You're not going to get the major upside, right? It's kind of like a cash flow business. The asset's worth something, but with real estate, you'll see this, and I want your listeners to be totally aware that you don't make a lot of money from the cash flow of apartments. You make, just like with owning rental homes, you buy this rental home and you make $100 a month in cash flow, or $200 a month in cash flow. And then it's not even that, right? Because, well, we got to replace the roof. Well, we got to replace the HVAC. The floor, the dishwasher leak. There's another $100, et cetera, et cetera. It just eats it up. But then a couple years later, when you sell that house, right, that you bought for 70 and now it's worth 150, you're like, wow, I just made a whack of money. This is awesome. And that's where you make your money. And you make your money the same thing with residential real estate, like, or apartments. You do make some cash flow. I'm not going to say you don't, but there's also a lot of expenses. There's stuff that's got to get fixed. There's repairs, maintenance, etc. But when you sell, the inflation's working for you, right? And now your property's worth a lot more than you paid for it if you take care of it and you get the rents up and you keep it full.
Right. Gotcha. Well, I mean, you mentioned obviously, that there is some, like any investment, right? There's some drawbacks, some challenges and all that stuff. I mean, what are some of the non-glamorous things that comes along with, owning apartments that, people should be aware of, not to deter them, but just so that, they have some kind of expectation of, some of the challenges that they may see.
Yeah, I would say the biggest challenges are the numbers are bigger and they get bigger. And the bigger you get and the more properties and projects you have going on, the more plates you got spinning and balls in the air. So if you think about a rental home and your AC craps out and it's $5,000 and that's $100,000 house. Well, think about that on a $5 million complex or $10 million complex.
Right.
A roof goes bad. It isn't 5 to 10 grand. It's $100,000 to replace that roof. Right. And you get delinquency creeping up and you're losing tens of thousands of dollars a month. Mm-hmm. And so same thing with the construction projects. Like if you're flipping a home and your budget was $400,000 and you go over budget by 25%, well, that's only 10 grand. It's 50 grand. Whereas if your budget is, $1 million, you go over, that's 250 grand. You just went over budget. So, and it's just as easy to go over budget 25% on these big projects as it is the little ones. Right. So, we bought a project in Georgia and it had all these through the wall, like PTAC units. They're called PTAC units, but they're kind of like, imagine like a hotel or a motel through the wall unit. And I mean, these things are crapping out left and right. And we're having to replace, I think we've already replaced like 40 of these things. And there's 2 to 3 per apartment.
Wow.
And we didn't have that in the budget. We spent $90,000 on these little through the wall units. And you got to do it, right? With no AC, nobody's going to move in. I mean, it's a forced expense. Mm-hmm. So the suckiest thing about it is it's missing your numbers where you underestimated the construction or you underestimated the expenses or you thought you'd be able to fill it up faster and the property starts eating cash. And when you going back to my first point, when you buy in C-class multifamily value add, that's how you make money, is buying these distressed properties, but they can take you down too if you're not careful. So I think that is like, you need to be liquid, especially the bigger you get. And that's why I don't encourage people to keep plowing all their money into down payments for the next. Like, keep their cash in reserves, raise the capital, and have a couple $100,000 so that when you go over budget, the partners can each chip in and keep the project going until you can refinance it or sell it or whatever. And that is a challenge, especially as you get bigger. So you can grow into that, right? You're not going to have major issues on an 8 unit or a 10 unit. Like, you can handle a little bit of cash here and there, 10 grand, 5 grand, whatever. But
Sure.
when you're getting up 100, 200 unit complex and it's losing $20,000 a month, you better have planned for that and have reserves and money in the bank.
Right, absolutely. I mean, like you said, you gotta buy right. That's obviously number one. And number two, I mean, I think, I mean, personally, to tackle, even if like you said, not many people are taking these down on their own. Even if they could, I just, like anything, you want to go ahead and deal with somebody that's experienced, that's going to shorten that learning curve. And if things start going south, right, we're talking multiples of 10 or hundreds, whatever, things could go, belly up pretty quickly. So I think, for me, I think it's definitely an excellent option to, at least for the first deals, team up with somebody that has experience in this. You'll learn a lot. It'll be less devastating to any drawbacks or issues that you encounter. But yeah, man, Jennings,
Yeah, that's one of the nice things about wholesaling, right? You're kind of, you're in, you're out, you're not tying up a whole lot of capital. And if you lose the deal, well, then you just lost a little bit of earnest money or whatever you put down.
right,
But you're constantly having to kill and eat, versus this. It's like, okay, a stabilized building could generate a couple $100,000 in passive cash flow a year, and it could generate a couple $1,000,000 in profits, and you're amortizing a couple $100,000 a year of principal, and inflation's working for you, and rents continue to rise. And in 10 years, you're laughing at the price you paid. So it's definitely a longer game, definitely has a little bit more risk and effort than wholesaling. But I see a lot of people do them in tandem. There's a lot of wholesalers in my group that they want to get the cash from the wholesaling, but they want to move into something that is more long term, that they can close it once, work hard one time, and then it'll be worth a lot more in 5 to 10 years when they need it.
absolutely. I mean, similarly, right? Like when you say, like, managing or dealing with an 8 or a 10 or a 15 unit, it's not much more work to be doing a 80 or 100 unit. They're almost the same. So you might as well opt for the higher units in some cases, right? And have better cash flow. And, at the end of the day, it's also the lifestyle that we're looking for, right? Like you mentioned wholesaling, that, hey, you got to go ahead and continue to work. Whereas you have rentals, well, you put in a lot of that, work up front, and then you have, your passive income on the backside. And especially if you're dealing with multifamilies and whatnot, you're dealing with multiples again of 10 or 100.
Yeah, I mean, we have $700,000 or $800,000 worth of rent every month rolling in, and yeah, most of that is going right out the door to expenses. But some of it's amortizing debt, some of it's going to us in cash flow, and we're controlling properties that we bought at a good rate. So we bought a property in Clemson for 3.8 million, or no, 4 million, and we're putting 800,000 into the remodel. So we haven't spent all that money yet, but we'll probably be about 4.5, 4.8 all in. And it's already getting valuations at close to 7 million, a little north of 7 million, and that in 18 months, right? Or less than 18 months. So it's pretty cool when the appreciation market works towards you. We're also pushing the rent rolls up and renovating everything and improving it. And it's just bigger numbers, right? You can improve the value of a house by 30%, 40%, but it's still an $80,000 house or $200,000 house versus a $5 million thing. Or the big boys are doing, $100 million commercial properties. And I have yet to get into that arena. So
Yeah, that's next level stuff. Well, I know you got to hop on your next call, man. Hey, I appreciate it. Would definitely love to have you back on. Maybe we'll dive in a little bit more of the management aspect and some other areas. Before we wrap up, anything you know you want to leave off on, any things you got going on as far as you know, courses, mentorships, events, whatever, any way that people can also get a hold of you?
Yeah, I mean, our deal room, our mentoring group is closed. You can't get into it right now, but we do open it up for limited spaces every 6 to 8 weeks. So the best way to connect with me is just in my Facebook group, My First Million in Multifamily. Hit me up on IG, Jennings Foster Smith Jr. Jennings Foster Smith Jr. Shoot me a message. I try to respond to most messages if I can help you. I mean, we have free resources, deal calculators, sample pitch decks we use to raise capital. We've even got like a little capital raising course, a mini course that's $47. You know, so it's a real easy way to see, like, do I like this? Am I interested in this? Is this something that I'd want to go down the road with? But yeah, that for starters is jump in the My First Million group, start building a relationship with us. And then if it's a right fit, you know, we got the mentoring group, which opens up every 6 to 8 weeks, but right now it's closed.
Awesome, man. I appreciate it. Well, guys, head on over to the Facebook group and drop Jennings a line. He's got a lot of stuff going on in there and a lot of helpful information. Again, thanks, man. I appreciate it, and I look forward to having you on in the near future.
Yeah, Ryan. Thank you, buddy. Appreciate you.
Got it.